So I just closed up a trade in sugar, the sugar CFDs. And I want to make a video because it covers a lot of the topics that are in this YouTube channel and over on our blog. And it was a sugar CFD trade. So what is CFD? CFD means contract for difference. And what you're looking at is trading the difference in price in an underlying asset. And in this case, it was sugar between the opening and the closing price of the contract. Now, there's no fixed contract size or expiration date for CFD trading. So that makes it a really good choice for all different types of account sizes. Also, you don't ever actually trade the asset itself like you do with other markets. CFD trading, it covers markets that includes stocks, indices, futures, commodities. And unlike futures, there's no overnight margin that you need to have to hold the positions. And before my American friends get all excited, you guys can't trade them. It's against U.S. securities law, and over-the-counter financial instruments like CFDs are regulated through legislation such as the Dodd-Frank Act, and they're enforced by the SEC. But you can still pick up something from this video here. Now first, when you're scanning for trades, you have to know what you're looking for. And there are a lot of instruments to choose from, so you really want to have concrete ideas of what you're looking for to narrow down your list to the top contenders. And it doesn't matter what you're using. It could be a 50-day moving average strategy or just trading off support and resistance levels. Regardless, you need to have a plan. So before we get to the actual trading chart, I want to look at the context of the market and using my preferred time frame of the daily chart. So the market was putting in a move down after a 33% run up in price from the end of September of 2018. In November of 2018, price ran into a former price zone that acted as resistance in the past from the middle of September 2018. And price bounced and it started to decline. And price breaks the previous low, but lower prices are rejected and price regains to the upside. Now, price had pulled back after the failed breakout into the former range, which now we can talk about how this becomes a potential trade setup. So this is the more recent chart of the CFD for sugar, and there are some really important elements I want to talk about. Like I said, for long-time viewers of this YouTube channel or reading our blog, all of this stuff has been covered in the content that we put out. Now understand that markets trend, they range, they break out, they trend again. And that's a never-ending cycle. And we can use that basic mechanic of the market to zone in on potential trades. So number one here, after price returned to the range with momentum, you see price forms a new smaller range under the resistance level of the larger range. That's bullish. Price breaks out, you can see it ranges, and then it pulls back into the smaller range again. Number two, I use the 4-hour chart from my lower time frame chart to zoom into these kind of areas. And with a bullish bias, I saw momentum to the upside and a bull flag pullback type of pattern. Now, the pullback was lazy. And that's really what I want to see for any thoughts of a long trade off of that pattern. At number three, I use a trend line as an entry tool only, and I place the buy stop order over the previous day high, which would coincide with a trend line upside break. And that eventually triggered in the trade. Number four, price ranged, and seeing that price was near the top section of the range, that still spells bullish. Price rockets through the resistance level, and there's momentum there. Number five, this is a swing high that coincides with one that's off to the left side of the chart where price had stalled. Now, stop loss and trade management. Any stop loss that I set has to be in line with the volatility of the market. So I use an ATR stop loss as well as an ATR for my trailing stop loss location. And I pull out partial position here when my trade goes in my favor that's equal to my risk. And at that point, the stop goes to break even. So why do I do that? Well, if the trade is moved to at least equal to my risk, then the trade's working. And I think that I should be rewarded for a job well done. So the momentum candle, it not only gives me profit, but it adds another important aspect to this trade. The momentum to the upside is large, and I look at those kind of moves as a gift. When momentum comes into the market, especially momentum that has not been seen for a bit, it's often wise to put the stop inside of the thrust around about the 50% mark of the candle. Large moves, they can often result in mean reversion, and it really makes no sense to go and give back all of those gains. And the price on the right side of the chart is at a recent high, and it's formed a range with a small pullback, which is the red candlestick. Now, ranges can be messy. And we often see price flush lower, especially when we're up against a potential turning point. So to guard against giving back much of a good trade, I have now placed the stop right underneath the low of the range. And price can flush lower, but then regain upside. But then you have to consider what your plans are for the trade. This is a swing trade. It's not a position trade. And I was looking for one clean move in the market, which has happened. And anything else, to me, is a gift. I can tell you right now, when the markets opened on Monday morning, price did flash down to the below the red line, which is my stop location, and took me out of the trade, which ends up being a winning trade. So just to recap, my whole point here is, number one, you really want to know what you're looking for in the market. Number two, have an idea of how you're going to manage your trade. And number three, understand what you are looking for in the trade. This was a swing trade, not a position trade. And I was looking for one clean move in the market, which I got. And to me, that's a successful trade. All right, thanks for watching.